Hello, Finance Virtuosos. Today, we have a topic that's been a point of contention among investors for years: traditional IRAs versus Roth IRAs. I'm here to unravel the complexities and help you decide which might be the better choice for your specific situation. As always, the answer is it depends. This is the Finance Virtuoso channel, where we talk about all things finance. For your daily dose of valuable information on money, business, investments, and savings, be sure to hit the subscribe button and click the notification bell right now. Before we delve into the differences, let's briefly touch on the common ground shared by both traditional and Roth IRAs. Firstly, both types allow contributions from minors and non-working spouses, subject to specific income rules. Additionally, the contribution deadline for both is April 15th each year. The annual contribution limits, as of now, stand at $6,000 for those under 50 and $7,000 for those 50 and older. Now, let's talk about Modified Adjusted Gross Income, or MAGI. To find your MAGI, you first need to determine your Adjusted Gross Income, or AGI, which is your gross income minus deductions like IRA contributions, student loan interest, and more. MAGI is then calculated by adding back some deductions to AGI. Let's use an example to make this clearer. Suppose you have a gross income of $50,000, and you deduct $5,000 for IRA contributions, $2,000 for student loan interest, and $1,000 for tuition and fees. Your AGI would be $50,000 minus $5,000 minus $2,000 minus $1,000, which is equal to $42,000. However, to find your MAGI, you have to add back the deductions for IRA contributions and tuition and fees, since they are not allowed for MAGI purposes. So your MAGI would be $42,000 plus $5,000 plus $1,000 equals $48,000. Why is MAGI important for IRA contributions? Well, because your MAGI determines whether you can deduct your contributions to a traditional IRA or whether you can contribute to a Roth IRA at all. There are income limits for both types of IRAs, and they are based on your MAGI. So knowing your MAGI can help you plan your IRA contributions and optimize your tax benefits. Differences in tax treatment. Now, onto the main event, the differences. The most talked about distinction is the tax treatment. In a traditional IRA, you can deduct contributions on your tax return, but with a Roth IRA, you can't. However, it's important to note that some exceptions exist for traditional IRAs. For instance, if you're married filing jointly, your spouse is covered by a retirement plan, and your MAGI falls between certain limits. Your deduction might be partial or non-existent. Roth IRAs are taxed upfront, offering tax-free withdrawals later, while traditional IRAs are typically tax-deferred, with taxes applied when you withdraw funds. Contribution age limits and amounts. Another significant difference is the age at which you can contribute. Roth IRAs have no age restrictions, but traditional IRAs only allow contributions until the age of 70 and a half. Also, there are some contribution limitations for Roth IRAs based on income. For instance, if your MAGI was between $129,000 and $144,000 for single or head of household filers, your contribution would be reduced. Penalties for early withdrawals. Now let's talk about penalties. Roth IRAs allow penalty-free withdrawals of contributions before age 59 and a half, but any earnings withdrawn early may incur a 10% penalty. In a traditional IRA, there's a 10% penalty in both contributions and earnings for withdrawals before age 59 and a half, with some exceptions. What are these exceptions? Well, there are quite a few. Some of the most common ones are: you become disabled or die, you use the money for qualified higher education expenses for yourself, your spouse, your children, or your grandchildren, you use the money to buy, build, or rebuild a first home for yourself, your spouse, your children, your grandchildren, or your parents. You use the money to pay for unreimbursed medical expenses that exceed 10% of your AGI. You use the money to pay for health insurance premiums if you're unemployed. You take the money as part of a series of substantially equal periodic payments based on your life expectancy. Let's look at some examples of how these exceptions work. Say you have a Roth IRA with $50,000 in contributions and $10,000 in earnings, and you want to withdraw $20,000 to pay for your child's college tuition. Since this is a qualified higher education expense, you won't pay any penalty on the withdrawal. But you will pay income tax on the $10,000 of earnings. Now, say you have a traditional IRA with $60,000 in it, and you want to withdraw $40,000 to buy your first home. Since this is a qualified first-time home buyer expense, you won't pay any penalty on the withdrawal, but you will pay income tax on the entire $40,000. As you can see, these exceptions can help you avoid the 10% penalty, but they don't necessarily eliminate the income tax. So, you should always weigh the pros and cons of taking money out of your IRA before you reach the age of 59 and a half. Required Minimum Distributions, RMDs. Moving on to Required Minimum Distributions, or RMDs, Roth IRAs have no such requirements, allowing your investments to grow tax-free for as long as you live. However, traditional IRAs mandate withdrawals starting on April 1st of the year following the year you turn 70 and a half. The amount is determined by life expectancy, and failure to comply incurs hefty penalties. Inherited IRAs. Finally, let's touch on inherited IRAs. If you're a surviving spouse, you have options: assuming the IRA, inheriting it directly, or disclaiming it. Each choice comes with its own set of rules and implications. For non-spouse beneficiaries, inheriting an IRA triggers immediate required minimum distributions. What are the differences between assuming and inheriting an IRA as a surviving spouse? Well, assuming the IRA means that you treat it as if it was your own all along. You can add your own contributions to it, and you don't have to take any RMDs until you reach the age of 70 and a half. This option is only available if you're the sole beneficiary of the IRA. Inheriting the IRA means that you transfer the funds to a separate IRA in your own name. You can't add your own contributions to it, and you have to start taking RMDs in the year after your spouse's death. This option is available regardless of whether you're the sole beneficiary or not. Phew, that was a lot of information. I hope this comprehensive breakdown of traditional and Roth IRAs helps you navigate the intricate world of retirement planning. Remember, there's no one-size-fits-all answer. It's important to evaluate your specific circumstances and financial goals. If you enjoyed this video or found it informative, don't forget to hit the like button and subscribe for more content on personal finance and other similar topics. And as always, feel free to drop by in the comment section below. Thanks for watching, and until next time, happy investing.